We're back on the podcast. What an interesting week it's been, Ernest. We've seen some worries about Middle East conflicts. We've seen the market pull back in April. And in Canada, we just had the budget announcement by the Liberals to make some sweeping changes for our clients, for many Canadians. We're going to talk about that not only on our podcast about how the budget impacts Canadians from an investing standpoint, but we'll also talk about on a financial planning podcast what that means, of course, for your portfolio and things that people should consider, what our clients should consider. And we also got an exciting feature company to talk about today. But let's get into the budget. We had a lot of clients always talk about, I'm worried at some point that the government will raise the capital gains rate. In Canada, most people will know that the tax on capital gains, if you have a capital gain, it works out to be about 26%, give or take, depending on what province you're in and how your money, and what structure your money's in. But there's been a change to that, and it's clearly an attack on wealthy Canadians. Trudeau says they want Canadians to pay more of their share, and as a result, the taxation on capital gains is not as attractive as it used to be versus dividends or interest income. Just to reiterate, we'll get into this more on a financial planning podcast, but taxation on interest income is generally at the highest marginal rate in Canada. Dividends were at a lower rate than interest income, and taxation on capital gains was the lowest. That's going to change for some Canadians, and for some structures, the tax on capital gains is not going to be as attractive. So, Ernest, from an investing standpoint, those that own investment properties, that own a business, that own equities and other investments that have gone up in value, how does the capital gains tax rate, how would it change one's investment strategy, for example?
Well, I think to your point, it's largely a financial planning question rather than an investment question. I mean, there's no doubt if you look at it on a societal level, additional taxes on investments, as a general rule, are going to lower investments. But then, like, is a hike in the capital gains inclusion rate really going to change a company's decision about whether they open a store in Canada or the US?
Probably not.
Probably not,
Yeah.
right? So,
so let me pose this question to you in a different way. Now that capital gains taxation is not as attractive versus dividends, or on par with dividends, would one say, I would rather own a dividend-paying stock in my portfolio than one that is going to give me growth and capital gains at the end of the day? Would they need to reconsider how they invest, or would we need to consider how we invest for our clients as a result of the level playing field, give or take, for capital gains and dividends?
Well, if you're a buy and hold investor, I think you still prefer companies that are reinvesting in their businesses, whether it be through organic growth, whether it be through acquisitions or through stock buybacks.
That's right.
Because it's still a deferred tax and you're still compounding on that benefit.
That's right.
But if you have a shorter time horizon, then I think certainly it plays around at the calculation a little bit on the edges, as your after tax return for dividends is now relatively a bit higher relative to capital gains.
Yeah, exactly. So I guess the answer is, like everything in life, it depends. But to make it more clear, what you're talking about on a fundamental standpoint, it really doesn't change whether a couche-tard or Apple is a better or worse investment because it pays more or less of a dividend. The things that matter, as you pointed out, are the growth opportunities, the ability to reinvest the cash flows at high rates of return, the ability to compound those investments over long periods of time. Whether or not there's higher tax to be paid on gains or not shouldn't have any change on how you invest as an investor. If you're a dividend investor and you like being a dividend investor, this shouldn't change it. If you're more focused on owning companies that have better reinvestment opportunities, this change in taxation shouldn't knock you off course either.
Right.
Would you agree with that?
Yes.
Okay.
And I think there was a bit of a sigh of relief, I think, because leading up to the budget, there had been some buzz that like the oil and gas sector was going to see a windfall tax, for example, and that didn't happen.
Because oil prices have been high at a certain level, tax them on a certain amount over and above what they should be earning, right?
Exactly.
Yeah.
And these things are often highly political as well.
Very much so.
So,
and probably wouldn't fly. Of course, Alberta would be very negative against that, to say the least. There have been, Ernest, we didn't even talk about this on our previous podcast, but there are now more taxes on buybacks in Canada. So companies that are buying back stock actually now have to pay a tax, and banks, there's a windfall tax, I believe, for the Canadian banks as well. These are not in this budget. These are prior decisions by our government.
yes, and I think if you put all of these things together, right? Like, I think it's hard to argue that there is not an impact on the investment landscape overall.
Yeah.
Especially from companies, right?
Well, this kind of ties to the previous podcast we did, which is called the Canadian Compounder Discount, which is on YouTube and all wherever you find your favorite podcasts, where we talked about there's a number of Canadian companies, great businesses, well-run businesses that may be mostly known as Canadian companies or trading mostly on the Canadian stock exchanges that trade at a discount. And it's possible, as a result of new taxation, that discount may persist, even though that nothing really has changed with the fundamentals of those businesses, just because there may be lack of investment in Canada as a result of higher taxes. I don't know.
Yeah, and for companies like Alimentation Couche-Tard, for example, like they're buying their convenience stores forever.
Yeah.
They're not going to, whether or not they have to pay more capital gains on the potential sale of these assets has no impact, right? But for an investment corporation, like a private one, for example, I think it is another deterrence to investment.
So many people have mentioned that this could speed up some acquisitions of assets by Canadian companies for the sellers that are looking to take advantage of the lower tax rates. The deadline, I think, is June 25th. This budget hasn't passed, by the way, but I'm pretty certain it's a done deal. By June 25th, so, for example, Constellation Software is a company that our clients own and we own. It buys a lot of different companies. It's always looking to make acquisitions from sellers. There could be more motivated sellers looking to sell their business over the next 10 weeks to take advantage of paying a lower capital gains rate. If you pay a lower capital gains rate, that means there's more money in your pocket. So there could be some motivated. So speaking from an investment standpoint, a lot of the companies that our clients own are acquirers, very acquisitive businesses, Couche-Tard, to name one, and Constellation Software. There could be a little window here where there could be a frenzy of activity or not. I mean, 10 weeks is not in Canada.
Yes.
Only, So, Matt, any comments on that?
No, not really.
Okay. So that's really all we have for you in terms of if there's going to be any changes for us from an investment standpoint. I think the answer is I would say no. I don't think a higher capital gains tax rate necessarily makes a dividend paying company a better investment. Really, that will depend on the fundamentals of that so-called dividend paying stock. I don't think the higher capital gains tax rate makes a growth company, less attractive, but it is what it is, and we'll try and navigate those waters going forward. So, Ernest, anything you want to add on any of these topics before we get into our feature conversation?
No, not really.
All right, fair enough. Ernest, we have owned a company called Waste Connections in our portfolios I would say, for about 20 plus years. The clients that have been at Baskin in the early 2000s may remember a company in their portfolio called BFI Garbage Trust. We were talking about the other day about all these, talking about taxes and surprises. For those Canadian investors who have a little gray hair or not as much hair on their heads as Ernest does, will remember the income trust debacle of 2007. On Halloween, October 31st of 2007, I remember taking my, how many kids did I have at that time? Anyway, one of my kids out for Halloween and hearing the news that income trusts were going to be disallowed, new income trusts were going to be disallowed, and the taxation on income trusts was going to go back to the corporate level. And prior to the 2007, for those who don't have any idea what I'm talking about, a lot of Canadian companies converted to a REIT-like structure where they paid out an enormous amount of dividends, and it was very tax effective, very tax friendly. So you had a lot of companies, small and big, that converted to income trusts. Many will remember that Bell Canada at some point wanted to convert to an income trust. Anyway, long story short, we owned a company called BFI Garbage Trust, which is in the waste hauling business in Canada. It was an income trust, and we owned it primarily for income. A lot of things that I'm getting off topic here, but the income trust, have you read about it? Do you remember anybody in the industry talking about those days and how it worked?
Yeah, it was a totally different market than it was today.
In Canada.
Because you had like all sorts of companies in many different industries that were essentially like REITs.
Yes.
Like they passed through most of their income and they were very tax efficient. So you had like Whistler Income Trust, for example.
We own that.
You had the Transforce Income Trust.
So the predecessor to TFI International was an income trust, a trucking business, a very cyclical business where people were relying on it 100% for income. That seems kind of ridiculous.
Right.
Yeah.
And as you pointed out, is it straw in the camel's back, or however that expression goes, was when Bell tried to convert to an income trust.
That's right.
And the government said, like, you can't do that. And then they got rid of it altogether.
Also, pensioners got, the pension funds that owned a lot of Bell's debt got nervous because technically speaking, these income trusts don't have a lot of cash flow to reinvest back in the business, and their balance sheets become worse. So there was a really concern that Bell's debt would be downgraded as a result of converting into the structure. So at the time, I think it was Stephen Harper and Jim Flaherty. They went crazy on this and closed the window, and that was that. The day after the Halloween surprise for our income trust, many of these companies fell in value by 20-30%. But had you bought the good businesses, that would have been a wonderful opportunity. So we owned a company called, like I said, BFI Garbage Trust. Probably started buying it around 2004. Predecessor to Waste Connections, a Canadian waste hauling business with some business in the United States. Was an income trust. After the conversion or the disallowing of the income trust, it's changed its name to Progressive Waste Solutions. And then I think, Ernest, was it 2016?
Yes.
So we've owned this for a long time. Waste Connections, which was a company in the U.S., acquired Progressive Waste Solutions, and that's how we've come to the genesis of owning the stock. So I've done a lot of talk about why we love the garbage business.
Well, we love the garbage business, but we also love Waste Connections specifically. Mm-hmm. Waste Connections today is the third largest waste management company in North America, behind Waste Management and Republic. And the waste industry is a pretty good business. It has elements that resemble the railway industry, right? These are irreplaceable networks of businesses. It provides an essential service. Mm-hmm. Everybody makes garbage. Everybody produces garbage.
Yep. Home, office.
That has to be handled. Mm-hmm. It needs to be treated. It needs to be taken away. It needs to be put in a landfill or recycled. Yep. Right. And this is a relatively recession-proof business, because people are making garbage in good times and bad times.
In recessions, some of the larger garbage from building commercial projects and oil and gas drilling, there would be less of those kind of wastes. But really, household waste really doesn't ebb and flow in a recession too much. So that's why they call it, it's not a recession-free business, but a recession-resistant type business.
And so if we look at the entire waste management industry, there's multiple elements of it. The first is the collection aspect, right? Where, you're driving a truck around, you're collecting garbage from commercial buildings, you're collecting it from households. Mm-hmm. Those are actually separate businesses, commercial and residential. Yeah. But that's the first aspect.
Commercial is usually picked up daily, give or take, depending on the type of business. Restaurants, obviously, you want to have a more regular pickup than once a week, and households and probably offices are once a week, give or take.
Mm-hmm. So there's the collection aspect. Then there is the transfer aspect, mm-hmm. where all the and the sorting. Yeah. So all the garbage gets taken to these centers. They get sorted for whether it's recycling or garbage, and mm-hmm. Deciding where to go. Right. So there's that aspect. And then the last aspect is the landfill, mm-hmm. the disposal. Yeah. Right. And that's the most valuable portion of the entire process. Yeah. Because of, I think out of all of the things that you don't want in your backyard, I think a landfill is probably would be close to the top of that list.
Pretty much. I don't want that in my backyard. Yeah. Okay.
And so the number of landfills in the United States has fallen from about 7,000 in 1980 mm-hmm. to about, I think it's about just over 1,000 today.
Really?
And it's because, they run out of capacity, yeah. and it's hard to get new ones approved, mm-hmm. right? And in the sites that are typically approved, there's already a landfill there. So the companies that own it tend to want to expand those mm-hmm. instead of building a new one somewhere else.
Yeah. Getting the zoning and entitlements and approval from the government to build a landfill, I would assume in this day and age is not easy.
So the landfill portion earns the highest margins mm-hmm. out of the entire process of waste treatment.
That's right. And because not only can Waste Connections trucks drop off the garbage, but Ernest's garbage truck can drop it off. Waste Management, Republic, anybody can bring the garbage to your landfill.
Right.
So, yeah.
And so
it's a tollway.
Exactly.
Yeah.
And so Waste Connections' strategy is that they want to focus on the best parts of the industry. Mm-hmm. So what are the best parts? The best parts are, so they're in the United States, there's two types of waste management contract or waste collection contracts, right? There are what they call exclusive contracts, where the city says to the company, here you go, you do everything for me.
Yeah.
Right.
We have that in Toronto, where half the city is under exclusive contract to a company called GFL. You may have seen their green trucks. And they have a 1 or 3 or 5 year contract to exclusively pick up residential garbage in certain regions in Toronto and the GTA.
Yeah. And in exclusive markets, it's very rare that the incumbent provider is switches out.
Yeah.
Right. And there's a variety of reasons for this. First is that the company is familiar with how the waste collection works in that city. Yeah. Right. The drivers know the routes. Yeah. Right. They know how to negotiate with the union. And more importantly is that they already have a fleet of depreciated garbage trucks to be able to go out and bid on this contract. Right. So it's it's very hard to have a fleet of trucks big enough to just go out and bid on a contract.
Yeah.
And so that's
chicken and the egg problem.
Yes.
Yeah.
So that's why if you look at somewhere like San Francisco, they've had the same provider for 50 years. Mm-hmm. No, it's not that somebody else can't come in and do it at a lower price. Yeah. It's not rocket science. Like anybody can theoretically do it.
You have the trucks, you hire the people, you're good to go.
But there's just no reason to do it.
Yeah.
Right. And so that's why they've had the same provider for 50 years.
Yeah. And
hasn't switched.
There's no incentive by the government. The person who's head of, I don't know, landfill services at some municipality, they're comfortable working with the supplier unless the supplier really screws up, or unless the price is, someone bids on such a lower price but even then
they wouldn't.
But you have to trust.
No, because as a resident, what do you care about? What you care about
is my garbage is gone by 10 a.m. in the morning.
Exactly.
And that's it.
And that is not piling up on the streets, right? So Waste Connections really tries to look for these exclusive markets, right? And since they never switch, the only way that you get these is you do acquisitions.
Yeah.
So a large portion of their business is in exclusive markets.
Yeah.
For the markets that are non-exclusive, these are what we call open markets or competitive markets, right? Here, providers have to go in and bid on individual portions of the business, of the collection. And if you are a vertically integrated player, if you own the landfills and if you own the transfer stations, right, it becomes much more easy for you to win the contract because you can take a little off the landfill portion, you can take a little off the other portion.
That's right.
And provide a competitive bid.
You can bundle the services for a great price. Whereas if you only own the garbage trucks or only own the transfer station, you don't really want to eat into your margin by offering a discount.
Exactly.
Yeah.
So Waste Connections, those are the two things that they focus.
Beautiful.
They focus on exclusive markets and they focus on smaller, less competitive markets where they are vertically integrated. And so if you put these things together, they're avoiding the hardest places to do business that are the most price sensitive.
Yeah.
And they're going to the places and making acquisitions of companies that are in the best places,
Yeah.
right? And so the strategy has worked really well over time. You look at their stock price, it's gone up basically straight line over time.
Yeah. There was a period, Ernest, up until I think 2022 and had a negative year where the stock was up like 16, 17 years in a row.
Yes.
It never had a negative downturn. Even in some very bad markets, the stock just kept going up.
And you can tell in their margins that they have the best assets.
Yeah.
Right. I think in the last fiscal year, Waste Connections had, I think, about 32% margins. Their main peers, Republic and Waste Management, are in the high 20s. And GFL, which you mentioned earlier, like they're the worst.
Yeah.
It's kind of well known that they, in terms of mix of properties, they are in the low to mid 20s.
Yeah. So we're talking about a quality company that earns better returns on its capital, better returns on the revenues it generates. And as a result, I think the stock price reflects that. It trades at a premium to its competitors, but for many good reasons.
And then I think beyond kind of the market selection and these kinds of things, one thing that I really like about Waste Connections is their culture, the servant leadership culture.
Okay. What does that mean?
So what this started when the CEO, Ron Mittelstaedt, the current CEO, he met a guy called Ken Blanchard.
Okay.
And Ken Blanchard wrote a book called The Servant Leader. And I think the thing you got to keep in mind about the waste industry is that it's a very tough industry. Like you don't want to work in this industry.
Yeah.
It's dangerous. It's low paying. It's smelly.
Yeah.
Right.
It's noisy. I mean, and anything that could go wrong can go wrong.
Yep.
Lots of accidents.
It's one of the 10 most dangerous in North America.
Yeah, and you're driving this big truck. You can hurt people. You can run over people. You can smash their property, and what you get for it is low pay.
Yes.
Yeah.
And at the time, Waste Connections was turning over their staff about like 50%. So
That's high.
people would come and then they leave after 2 years.
2 years. That's it. Yeah.
And then in their exit interviews, they would ask them, "Why are you leaving?" They said, "I don't like it.
Yeah.
I don't like this place."
Yeah.
Right. So Ron Mittelstaedt went and talked to this guy who wrote a book called The Servant Leader.
Yeah.
And he was really inspired by the idea that the management of a company should be there to serve the employees, right? And so he created this whole culture, there's like a book about what it means to be a servant leader. And he implemented it through Waste Connections. And what this means on a practical level is that the company is going to take care of its employees. It's going to be there to empower its employees to make the right decisions. So it's a very, very decentralized business. So you do what you think is right. And the managers are there to serve the employees, right? And what does this mean on a practical level? It means that during 2020, during the COVID pandemic, if you were a truck driver and your kid and your wife had COVID,
Yeah.
and you couldn't go to work, Waste Connections was going to keep paying your wages so you could stay home and take care of your wife, right? They spent, I think it was $36 million on these supplementary employee wages, including 12 weeks of pay for childcare
Yeah.
in times that their employees weren't working, right? And, like this is all money that's coming out of the company's pockets.
Well,
but
it's also coming out of our clients' pockets who are shareholders of it. Yeah.
but it creates a tremendous amount of employee goodwill in an industry where having this employee goodwill is super valuable.
Yeah.
And this benefits Waste Connections from a cost perspective as well, because they have the lowest employee turnover, so you don't have to go out and find drivers. This was extremely valuable in 2022 when no one could hire anyone. And a lot of companies, like especially independents, they just couldn't find people to complete their service. This matters from insurance because they have one of the lowest, it's not disclosed, but they have the lowest injury rate.
Yeah.
So they pay less like out-of-pocket costs for healthcare claims and insurance, right? And so there's all these kind of little benefits that Waste Connections gets because of this special culture that they've built.
And so you won't see it directly in the day-to-day results, but you'll see it over time in the results of the company and its ability to keep these high margins as a result of taking care of its employees.
Exactly.
And those are the types of things we love to see in companies. Culture first.
Yes.
Right? Because we talk about this all the time. If you're a long-term investor, and our clients have owned not Waste Connections directly, but Waste Connections in some form or fashion for almost 20 years, and some of the clients have compounded their money by 10, 15, 20 times on this stock as a result of culture, of reinvestment of the cash flows. Not, oh my God, the market's going down today because I'm worried about inflation today or interest rates today or that or this or that. That doesn't matter over the long term. What matters over the long term is the management and how they treat the employees and how they try and do everything they can for shareholders, stakeholders, employees. Waste Connections is a model of that type of company.
And this is actually, I think, a bit counterintuitive because oftentimes I think there's a perception that in capitalism, you have these big evil corporations.
Yeah.
All they're trying to do is just squeeze the employees at the bottom to make the most money for the shareholders at the top.
Yeah, such a ruthless, terrible company, right? Yeah.
But then if you look at companies like Waste Connections, you look at companies like Costco. Yeah. Costco is another great example. Yeah. They have industry-leading pay. It's the companies that are able to pay their employees the best and treat them the best. And they end up, because of the culture that they've built, they're even more successful than they otherwise would have been.
Very interesting. So the opportunities going, Waste Connections has been a very acquisitive company. It's managed to make a healthy amount of acquisitions each year. Ron Mittelstaedt, who did take a leave of absence, I think, for health reasons, is now back leading the company, which is exciting. And I think the company lost a little bit of its way with the servant leadership model, but Mittelstaedt brought it back and already seeing improvements, fewer turnover. When inflation was high, really high, and there was, people were competing for jobs and the market was really tight, whether you had this servant leadership model or not, it was going to be very tough to maintain employees in the truck driving business. But I think things have turned right now for truck driving. So Waste Connections is really having no issues on that front. But catalysts, we're always looking out out the front mirror to see what, what at the windshield to see what we can earn on the investment and what wonderful things Waste Connections is doing. So why don't you talk about? There's some exciting things that they're working on that we think can really add some materiality to the bottom line.
Well, first of all, I think they're going to continue to make acquisitions. Like every year, they deploy a significant amount of cash flow just into acquisitions. And these are more regional players that they can go in, they can upgrade the equipment, they can install servant leadership, and generate returns that way.
So for those that don't know, the waste services industry has many competitors, many small regional players in the thousands.
It's about In the industry, about 50% is independents.
50%. And it's the garbage waste industry in North America is gigantic. So there's lots of room for waste to make acquisitions going forward.
So one example is that they recently bought a company called Arrowhead. And what Arrowhead does is that it owns a rail that connects between a landfill and I think and some sites in in the Northeast United States. So what this allowed Waste Connections to do is go out and make acquisitions of collection companies in these areas because they can now vertically integrate with the landfill.
They can move it to one landfill and put on rail and move it to another landfill.
Exactly.
Exciting.
And so these are the kind of deals that they're going to continue to do.
Now speak about, Ernest, if you can, about this RNG business that everybody's excited about for landfills.
So that's another opportunity that it could provide a little bit of upside in the future. As it turns out, landfills create a lot of toxic gas.
That's right.
Mostly methane.
Yeah.
And it turns out that you can actually collect this gas and turn it into electricity. I have no idea how that works.
No idea. And it's a renewable fuel.
Yes. But the exciting thing about this is that you can actually capture this gas, turn it into a renewable fuel, sell it for electricity, and earn renewable power credits from the EPA.
Yeah.
And this is something that I think the whole industry is working towards. Waste Connections has a handful of projects currently looking to build these renewable natural gas facilities on their landfills.
Yeah. I mean, take it for what it's worth, but I think Waste Connections said that they believe they could spend about $150 million over the next 5 years and have a renewable fuel business that generates $150 million a year of EBITDA.
Yes.
So that would be a pretty good allocation of capital to put up $150 million and to earn $150 million of earnings pre-tax for a very long period of time.
The other, and I think, and beyond that, and we didn't even talk about this, is the recycling business and their energy waste business. I think these are, relative to their core municipal solid waste businesses, they're relatively small, but Waste Connections does have a business that handles waste from energy or like oil production. Yeah. And this is a very cyclical but high margin business, which is relatively uncorrelated with the existing business. And they just bought a business in Canada that handles energy waste. And that's something that will likely grow in the future.
So they're getting into other areas of the waste business, becoming a vertically integrator, and ones that probably have some very high returns on capital.
Yeah, and one last thing I would add about the industry is that there's probably going to be some nice margin expansion going forward in the form of robotics.
Okay.
Still today, it's a very labor-intensive business. And the industry overall is looking for ways to use robotics to save on labor. Yeah. And I think this is, you can just do a Google search. There's tons of efforts to use robotics and laser vision and those kinds of things to improve the way waste is treated and handled. Yeah. And I think this is going to be a nice tailwind in the future as well.
That's right. So, I mean, some of the trucks now only have one driver, and all the collection is done by the truck itself, right? This is not AI. This is just the mechanics of the truck, right? You don't need a person out there putting the garbage bins into the back of the truck.
Exactly.
Right. So but as you talk about in the future, there could be potentials with AI or robotics, machinery, what have you, to increase margins. So there's fewer people, more productivity, faster collection on routes. We'll see what happens. But you would obviously want to bet on a company that already is already a major industry player instead of a ma and pa type business.
Well, and the reason to think that Waste Connections is going to benefit more from these is that, again, it goes to their market selection. Yeah. They have exclusive contracts already. So to the extent that there's any margin upside, they're probably going to be keeping it for themselves.
Anything that I didn't ask you that I missed about Waste Connections or the industry? Or
no, I would say it's not the cheapest stock
Yeah.
out there. I think it's a high quality business that is recognized in the markets as such.
Yeah.
But as long as they continue to execute properly, I think you're going to do pretty well.
Any negatives right now? There have been some headlines that there was some bad smells in one of their landfills that they had to clean up, or an overheating issue in another one of their landfills. That was a headline risk that we saw on the company that I think the company's rectified. Anything you see in terms of negatives that people should consider when owning Waste Connections?
Yeah, the nature of the industry overall is such that it's prone to negative surprises, right? Landfill business is a tough business. There's a lot of environmental issues that have to go into running these landfills.
Yeah.
And I think this was probably one of the reasons that Ron came back, was that he saw that there was a little bit of slippage in the way that the company was handling these things. Incident rates and turnover were going up a little bit, and he wanted to come in and fix it before it got out of hand.
Yeah.
And so that's just the way it is.
Well, so if those that remember, when we talk about the things that we look for when we check the boxes for a compounder, we love companies that have great culture, where there's an owner-operator running the business, and that's with Ron Mittelstaedt back. He's the founder of Waste Connections, made a ton of money. He doesn't need to work. He's back working, back watching his baby, and he's still a youngish guy, right? So we're excited about that. We're excited about some catalysts going forward, as well as over time, the amount of garbage that the world produces should grow with GDP. And if you're like us, and we think that over time, North American GDP, population grows, wealth grows, more garbage that we produce, should be a pretty good line of sight for Waste Connections going forward.
Well said.
Well said. And anything people can read about Waste Connections if they want to find out more?
They put their servant leadership handbook on their website.
Yeah.
If you're looking for a job in a good culture company, they're always looking for drivers.
Yeah.
But I think beyond that, I think
we're waiting for the book on Ron Mittelstaedt, because he's one of the true outsiders, or whatever you call it, great capital allocators of our time.
Yes.
Well, great to see you. Thank you for following our podcast on YouTube and Spotify and Apple. Please give us a 5-star review. We'd love that. We'd love your comments. We'll do very soon a podcast, probably next week, on the budget and what that means to your finances. And thanks, Ernest, for joining me today. And we'll see you back here real soon.
Bye.